OPEC Plus cuts production, oil prices surge. Here's what you need to know before the bell. Over the weekend, OPEC Plus cut production by 500,000 barrels, sending oil prices higher by about 6% this morning, back to $80 a barrel. Now, this is not surprising, by the way. Oil prices had gotten up to about $115 a barrel at the beginning of the year. The correction in oil prices is a function of really just two things, right? As the economy begins to slow down, well, you're obviously also going to see a slowdown in demand for oil, which brings down the price of oil. Second thing here is that oil prices fell back to the long-term 200-week moving average. Now, this moving average runs over a 4-year period. So think about that for a second. In order to have a moving average, prices have to trade both above and below that average over a period of time. And you can clearly see that. Here is a big deviation above that moving average earlier this year, following the massive decline that you had in 2020 below that moving average, all the way back through history. So when oil prices retrace back to that moving average, OPEC Plus says, hey, we're back to where we like profitability. We need to cut production. We need to reduce the amount of supply available on the open market in order to get prices up because, hey, we like higher oil prices because that's where we make money, right? So not surprising that OPEC Plus will do this. Of course, the White House shocked and dismayed by this issue, saying, hey, it's not advisable for you to cut production when we're trying to bring down inflation over here. You're trying to raise prices. This is going to be a little bit of a problem for the Federal Reserve in terms of pausing on rate hikes. So we'll see how this all plays out. But nonetheless, oil prices moving up. Now, again, what is interesting also is that since the beginning of this year, the worst performing asset class for the market this year has been energy. Of course, this follows the massive outperformance of energy stocks last year. This is a chart of XLE, which is the energy sector ETF. Now, interestingly enough, despite the big correction in oil prices down to the 200-week moving average, energy stocks remain extremely elevated above that moving average. In other words, energy stocks have not reflected the price declines in oil because that hasn't passed through their earnings yet. So again, while oil prices are rising up off their lows, energy stocks are still very overbought here. And again, so one thing to think about here is that we may see a short-term bump in energy stocks, but it is unlikely that energy stocks are going to continue to remain this deviated above this long-term moving average indefinitely. In fact, going back in history, deviations from this moving average have always corrected themselves back through history. And those corrections tend not to be very kind to investors. And this is a function of the fact that if oil prices are high and we start to slow down economic growth, then we're going to see a slowdown in demand, and both oil prices and energy stock prices will catch up. So again, one thing to pay attention to here is that while OPEC did cut production, it doesn't necessarily mean we're going to have a similar run. We may in the short term, but we're not going to see substantially higher energy stock prices over the course of the next 3, 6, 9, 12 months because of this current deviation above that long-term moving average that will have to be corrected at some point. I'm your host, Lance Roberts, and that's what you need to know before the bell.